We've got earnings from Wells Fargo and JPMorgan Chase, and we're playing Investing Chicken. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I am David Hanson, normally joined by Matt Kopeneffer, still in Africa. So I'm joined by Billy Kipperstock, analyst with the Motley Fool Options, Motley Fool Pro Services. Billy, give us a quick elevator pitch what those services do.
Yeah, so Motley Fool Pro is a portfolio service. We are kind of more for the more involved investor. We do short stock, long stock, options, ETFs, and the goal is to get absolute returns over any market cycle, whether it's up, down, or flat. And then options is more of kind of like a idea service, kind of like a stock advisor, rule breakers, just for options. All
right, well, we're glad to have you here. We are going to start off the day, not quite to the headlines yet. We've got this video from this, I guess it was a protest yesterday over in one of the Senate buildings. And here's the video, very interesting. I think they're protesting Monsanto. They're throwing money in the air. If you're listening on iTunes and you can't see the video, they were throwing money in the air. I guess the technical term is making it rain, perhaps?
Making it rain, yeah, I guess that's what the kids call it these days.
Have you ever seen anything like that?
I have not, no.
Well, that's what I was doing earlier in the year when the University of Miami beat University of Florida, your alma mater, in football, so that's how I was celebrating.
Well, you're wearing nice colors today, orange and blue, so.
All right, well, we'll move on to the actual headlines of the day. The first one is from the Wall Street Journal. JPMorgan reports loss after $9.15 billion legal expense. So, of course, JPMorgan and Wells Fargo reporting earnings this morning. On first glance, you look at that and you say, wow, that's got to be terrible for the stock. I'm sure the stock's down 10%. Well, no, I think the stock was basically flat, even up before the bell there. So when you look at the headline, it doesn't look good, but this isn't a surprise. We've been expecting this big legal cost for JPMorgan. They're almost reaching these settlements with the government, so it was almost inevitable. But when you look under the hood a little bit and look at the underlying business, investment bank performed very well. The consumer bank still performing very well. So headline doesn't look good, but the performance is still there. We're going to talk a little bit more about that later in the show, and we'll move on to our second headline of the day. This one is from Bloomberg. Wells Fargo posts record net income as Stumpf curbs expenses, and that's John Stumpf, the CEO there. So they did. They posted the record net income. A lot of people thought they didn't. It was a good quarter, right?
Yeah, it seems like, a good quarter at first glance. A lot of people were expecting, kind of that streak of record net income to break this quarter, but it looks pretty good at first glance. I mean, return on equity is up. It's actually, Wells Fargo is down a little bit right now. The stock itself is down about 2%. I believe the market is reacting to lower revenue, but it looks like the figures are pretty strong.
If there was one thing, and I know we're going to get into it a little bit later, if there's one thing that you didn't quite like, or one thing that was maybe just a little bit worrisome, was there anything?
Yeah, I think, my answer to that would be they are relying increasingly on improved credit quality to come up with a lot of their earnings. So we'll get into that a little bit more later, but yeah.
All right, moving on to our final headline of the day. This one also from the Wall Street Journal. In latest IPOs, profits aren't the point, and it's highlighting that, I guess it says there in the title, 2/3 of US listed tech debuts in 2013 lost money. So the Wall Street investors, they're not quite looking to the bottom line quite yet, focusing more on just total revenue. You look at Twitter, pulling in some good revenue numbers, but still unprofitable last year. Just stepping back and looking at IPOs in general, whether it's a tech IPO or another industry, a lot of individual investors stay away from IPOs. They can be risky, they can be volatile. Personally, is this a space that you're interested in? Are you an investor that goes in there and buys an early IPO?
Typically, I would say no. I think it's dependent upon the situation. Some companies, are very strong companies, great competitive advantages, and they can, be profitable in the future, even if they're not profitable now. And those would be the companies that I would say I'm more likely to consider buying their IPO. But we've seen kind of a pretty exuberant IPO market lately. A lot of companies up over 100%. In their IPOs. I think we've had 4 companies, Potbelly, Benefit Focus, Sprout Farmers, and Noodles Company over the past couple of months. All of them up over 100%.
On their
first day of trading.
Yeah.
Yep, exactly. All of them, in fact. This would be an IPO market that I probably would not want to buy into, but I think it depends on the situation.
Yeah, when we just go back and look at that headline where it says profits aren't the point, I saw a tweet from our colleague Joe Mager, and he says, guess when this headline was printed? It wasn't 99, it wasn't 2007, It was today. So I don't think we're quite to the point in '99, and the article also points out that back in the tech bubble, there wasn't even revenue for a lot of these companies. We at least have the revenue numbers now, not quite to the bottom line.
That's right.
So I don't think it's quite as exuberant, but I'm with you. It makes me a little bit uneasy.
Yep.
All right, moving into our next segment, mentioned it earlier in the show, going to be looking at a little bit deeper details of the Wells Fargo, of the JPMorgan earnings report. You cover Wells Fargo for the Pro service. That's a stock that's kind of on your coverage list. What were some more things that stood out to you this quarter? Was it really a good quarter? Does Wells Fargo still look like an attractive company going forward?
Yeah, I think, I just basically glanced at the financials and kind of did a little bit of a review.
I'm not expecting you to do a full debrief.
Not going
2 hours in.
Too detailed.
But on the surface, what did you see?
So 3 things. So the first thing for me is the mortgage business. Obviously, we were expecting kind of that business to decline as the refinance volumes kind of normalized, as rates increased. As we expected, we saw a big decline in income from the mortgage business. We saw it decline from $2.8 billion to $1.6 billion quarter over quarter, and of course, rising rates are the culprit there.
Right.
The second thing that I was looking at was the net interest margin. I think that's something that we want to monitor for Wells Fargo. So as far as the net interest margin, it declined also sequentially quarter over quarter, due primarily to deposit growth, which is the denominator of the net interest margin equation. Wasn't because their interest income was down, it was actually flat. But that's also something that we should be watching as rates continue to rise. And then the third thing that I was watching, I kind of alluded to this earlier, is the credit quality. So they, part of their net income, part of their record income was a $900 million reserve release, as opposed to a $500 million reserve release last quarter. So increasingly you see that they're relying on improved credit quality to boost their earnings, and that's something that we want to monitor going forward.
Right, and you talk about the credit quality and releasing those reserves. There's a lot of people out there that look at that and say, well, that's not core earnings, and it's not in a sense, but it's also money that they reserved before and took out of earnings in prior quarters. Right. So it still is earnings, but it is, like you were alluding to, it's not a sustainable way to continue to grow the profits.
That's right.
And on the mortgage banking business, obviously the big declines, that's obviously expected. They came out multiple times and said, it's going to be lower, guys. Don't expect a record quarter here. But when you look at the bottom line of the mortgage business, it's going to continue to improve over time. It just takes longer to take costs out rather than people stop getting their mortgages. It takes a while to maybe lay off some employees, reduce some of those expenses. So over time, it'll start to look better.
And that's also something I wanted to bring up. I believe Wells Fargo's efficiency ratio increased, so that means that they were less efficient and their expenses increased. So that's something that we want to watch too.
Absolutely. Moving over to JPMorgan, just a couple things that stood out to me other than the legal expenses. We'll stay out of that for now. They set the money aside. Jamie Dimon on the call this morning said, it doesn't make me feel good. I don't like losing money, but we have to set it aside. We have to be conservative going forward. So the 3 business things that stood out to me were the investment bank and corporate bank. So we look over at Wells Fargo. They do have a strong corporate bank, commercial business. The investment bank, very small part of Wells Fargo's business. Not so much at JPMorgan. It's a big part of their business. And Jamie Dimon, he was bragging. He said, I'm going to brag about our investment bank for a minute on the call. He noted that they're on the Verizon deal, they're on the Nokia deal. So they're getting their hands on a lot of deals. And when you look at the business of JPMorgan, doing very well right there.
A lot of the IPOs that we mentioned, I believe that they're on
exactly, as well. So when you look, the headlines are ugly, but the people inside JPMorgan, the investment bankers, the corporate bankers, they're still doing a good job. The second thing was, you mentioned consumer banking over at Wells. Consumer banking at JPMorgan I thought was pretty impressive as well. They led deposit growth year over year among all the big banks. And when you're talking about these low-cost deposits from consumers like you and I, the average rate that they're paying on interest-bearing accounts at JPMorgan right now, 0.25%. I mean, that is, they're essentially getting free money here. And we know as bank customers, banks aren't paying anything on savings accounts, so not quite a benefit to us as consumers. But these banks have all these low-cost deposits, and they're trying to find places to put them. But I think Wells Fargo, JPMorgan, they're being conservative. They don't want to reach out and just put it in any old security or any old loan.
That's right.
And the final thing was fixed income trading, and this has been a headline in the financial sector. predicted to be lower across the board at Wall Street banks. We saw Jefferies come out a couple weeks ago, and their fixed income trading, which I should say fixed income trading, this isn't JPMorgan going out and making bets with their own money. This isn't London Whale type stuff. Fixed income trading is driven by clients, so hedge funds, institutional investors that trade through JPMorgan. That's fixed income trading. It was only down 8% year over year at JPMorgan compared to 83% at Jefferies. A little bit of a different comparison there, but not quite as bad as maybe some would expect. So looking at both of these banks, I think the bottom line is there's some headline stuff with JPMorgan, Wells Fargo. Maybe it wasn't a sexy quarter. Revenue was kind of flat, but at the end of the day, they're still really big profit engines and that are going to continue to build book value.
Solid
over time.
Performance. Yep. Business as usual.
Yep. All right, moving on to the next segment. Let's lighten it up a little bit. That was some stuffy earnings stuff right there. All right, we're going to play the game Investing Chicken.
All right.
Today.
Let's play some chicken.
There's the chicken. It looks good. All right, the way this game works is for you've never played, and for anyone who's watching or listening who has never played this game, we look at two stocks, and today we're looking at B of I, Bank of Internet, and Wells Fargo, and we give each other a scenario about the company, about the stock, and we ask the person, would they sell? Are they going to be the investing chicken? So I will throw the first one up to you. This is about B of I, and for those of our viewers or listeners who don't know what B of I is, this is an internet-only bank. They don't have the sprawling branches that Wells Fargo, JPMorgan have. They have one branch, right? I think it's their headquarters.
Yep, headquarters in California.
Yep. So they've been growing deposits rapidly because they pay a little bit better of an interest rate on those deposits.
More than that 0.25 from
exactly.
JPMorgan.
You're getting a little bit more at B of I. So the bank's been growing very rapidly, but the stock's been on a great run too. I mean, it's up over 100% over the last year.
Yep.
So my scenario going to you, you're a B of I shareholder. So this is a real life scenario we got. Price to book value, right now it's around 3.4, which is pricey. You look at Wells Fargo, it's under 2. So price to book value goes to 4 times, and non-performing loans jump from 0.8% to 1.5. So the loan quality starts to get a little worse, and the price is a little bit, I guess, pricey.
Yep.
Are you selling? Are you a chicken in that scenario?
Well, to be honest with you, I have gotten a little skittish with this company as it is. You mentioned it's gone up over 100% over the last year. It's a really fast grower. If it can maintain its growth rates and maintain its performance, I think it can continue to do really well. But that price to book that you mentioned, I think it's around 3.4, 3.5 right now.
Yep.
Is a little scary for me. So that might be a point at which I do consider selling.
Okay.
So
as long as you're considering, I'll consider that a win for you.
Yep. Okay.
All right. What's your scenario?
Okay. So my scenario is.
And I am not a B of I shareholder, but I think it is a very well-run bank. I think it's an interesting business. If you're not going to go out and buy the stock today, I think it's certainly one to watch. It's an interesting business.
Yeah. So my scenario is Bank of Internet. Obviously, they're growing really fast. Deposit and loan growth well over 25, 30%, and that's kind of crucial to the investing thesis. You need that to continue to happen in order to make this an attractive investment. So say deposit and loan growth drops to 10 to 15% this quarter when they report.
Oh, wow. That would definitely be a concern. Like you mentioned, okay, we just mentioned the 3.4 times book value.
Yep.
And that sounds like a lot, but the business is performing well. Returns on equity are 18%, which are pretty healthy. And especially when you're growing deposits at 30% a year, that multiple is potentially justified. Potentially. I'm not going to go quite far and say it's potentially justified. So if that growth started to slow and they couldn't get deposits, it's going to look increasingly likely that multiple is not justified. So if growth starts to slow that significantly, I think that would potentially be a time to sell B of I.
Okay. So all right, be a chicken in that scenario?
I think we're both chickens.
Yep. Okay.
All right, moving on to Wells Fargo, a much bigger, more established bank here. And do you own Wells Fargo or no?
No, I'm not a current shareholder.
All right. Well, we'll play the scenario as if you are. All right, Wells Fargo. I'm going back to the price to tangible book here. Okay. And again, when we talk about banks, we don't look as much at the PE ratio. It's really a book value business, so we're valuing them off price to book and price to tangible book. So Wells Fargo moves up to 2 times tangible book value, and new capital rules, we have all these regulations floating around, make it virtually impossible to have ROE of 15%. It's probably going to hover around 10% going forward. Does that make you, so maybe not selling, but are you just not even interested in the stock then?
Yeah, I think at that point, it makes it hard to justify, it being an attractive opportunity. Mm-hmm. Obviously, as an investor, you have to be, you have to consider, the price which you're paying,
right.
And the price to book is relying on that return on equity. So if Absolutely. It can't go higher than that 10%, it's hard to justify a 2 times book multiple. It's such a well-run bank and it's such a strong bank that you could just hold really forever. Mm-hmm. And Warren Buffett has and does continue to do so. That I wouldn't say maybe sell it, but at that point I probably would not be adding more or starting a position.
I mean, yeah. Before you get to yours, I'll just add that when I look at Wells Fargo and I was trying to think of scenarios that would make me sell.
Yeah.
It's really the price, Yep. I don't think it's the underlying performance. I'm not worried that the franchise is going to suffer, that the corporate bank is going to suffer. So it's when you look at Wells Fargo, I don't think you can just ignore the operations, but to some extent, I think you have to be a little bit more mindful of just what's the price that you're paying.
Yep, I agree with that. Yep.
All right, what do you got?
So my scenario. So kind of as I went into this a little bit earlier, they're relying a lot more on improved credit quality to report their earnings. So if we had a quarter with a big jump, unexpected jump in charge-offs, say it went from what is it now, point something to 1%.
Right.
Would that make you consider selling?
It would not. As I just mentioned, I guess I got ahead of myself in terms of the performance. I think when you look at a quarterly performance in a bank like Wells Fargo, that shouldn't be a concern. We mentioned the stock's down today. It doesn't matter with a bank like Wells Fargo. It's such a big company. It has such a good track record of making strong returns for its shareholders. So a 1 quarter blip in terms of charge-offs, it wouldn't make you feel good at night, but I think you'd get over it. I do not think that would be a reason to sell.
So you wouldn't be a chicken there?
No chicken here.
No chicken.
All right, moving on to our final segment of the day on the Twitter sphere. Our first tweet of the day, it's a happy one from Laura Marcinic. She says, "Merry bank earnings season," and I am not going to bore our viewers and listeners anymore about bank earnings season in terms of Wells Fargo and JPMorgan, but give me another company. It can be a bank, it can be just any old company that you're excited to watch this earnings season.
Yeah, so my company, I would say, would be Capital One.
So you're going with a bank.
Going with a bank. Okay. This is a financial show here. So Capital One, the reason being, I know you and Brendan discussed this a couple of shows ago, the warrants.
Right.
I'm actually I actually own some of the warrants in my own portfolio. Talked about kind of how the time value is very small in relation to the duration of the warrants. So that's a company that I want to continue to monitor, see how they're performing, making sure that they're able to kind of hit their targets and hopefully increase, the value of my warrants.
Absolutely, yeah. And the show you referenced that was yesterday. So if anyone's interested in listening to that, we had Brendan Matthews on from Stock Advisor, and he gave us the pitch for the Capital One warrants. Very, very convincing.
Yep.
The company that I'm watching is eBay. And I know this is a company that you like to follow.
Yep.
And we talked about it a couple shows ago that I'm really interested in the PayPal business, and just to see, is this business going to continue to grow and make up an even larger part of eBay's revenue? I think it's around 40% now. So just see, is eBay making inroads in terms of getting into stores? Or PayPal, are they making inroads and getting into stores? And is that business continuing to grow? So that's one I'm excited to watch.
Yeah, I'm going to add something there too. I mean, the growth in the PayPal unit there has been phenomenal. It's been, I think, 25% annualized over the past 5 years. Spectacular growth rates, and analysts are predicting that it's going to continue to grow 20-something% over the next 5 years, and I'm going to be watching that as well. And I'm not sure that that's reasonable.
Yeah, and they've been huge on mobile too. They've adapted very well to that shift in mobile, so that's part of the growth there. All right, moving on to our second tweet. This is from Nick Timmeros from the Wall Street Journal. He's their housing guy. He says, refinancing is down, but purchase lending is up or flat. Purchase lending is what matters for housing. We talked about the Wells Fargo and JPMorgan mortgage banking. It doesn't look great because so much of the business was refi, but he's just pointing out that when we talk about the housing recovery and what's really going to drive housing prices, it's more important to look at the purchasing money, who's out there actually getting first mortgages and buying homes. That was down at Wells Fargo, but I don't think that's, and it was up at JPMorgan, so some people might wonder where's the disconnect there compared to last year. That's why Wells Fargo is down, is I think competition has just ramped up. Last year, Wells Fargo and JPMorgan, they were like the only ones giving giving home loans, Bank of America was still out there, but they hadn't ramped up their operations.
Yep.
I think it's just Wells Fargo maybe just losing a little bit of ground because it's a little bit more of a competitive space this year. Yep. So I think he makes a good point. That's a number to look at.
Yeah, and I mean, we've gone through a pretty unprecedented period of refinancing because of the low rates, and obviously it's not sustainable. So that's what we want to be looking at, is that.
Absolutely.
Yep.
All right, moving on to the final tweet of the day. This is from Charlie. He says, fantasy football is to prove that you are better than your friends. That's an interesting tweet there, and I'd have to agree with that. So speaking of fantasy football, we did a fantasy stock draft.
Yes.
A couple months ago now. It's been a while.
Wow.
Yeah. And you can actually follow all those picks. We have a Caps profile. There it is. It is TMF Stock Draft 13. It was me, you, Matt Copenheffer, and Brendan Matthews, who was on the show yesterday.
Yep.
We all made picks, 5 each. And unfortunately, you're winning right now.
Unfortunately for you.
You are winning right now. Your picks are outperforming the S&P by a total of 6%. Not bad. Mine are lagging by a total of 2%. That is not good. You're beating me by 8 percentage points there. What do you have to gloat for a second?
What can I say, David? I don't know. That's my way of making up for your Miami dig at me earlier.
And the one that's leading the charge for you is MasterCard.
Yep.
And Brendan and I talked about this on the show yesterday. I look at the stock. Is there anything that's gonna stop this company from continuing to perform well, or are you still just as bullish on the company as you were when you selected it for the draft?
Yeah, it kind of goes back to that conversation we had about Bank of the Internet. Is this is a fantastic company, growing at very, very high rates, performing really well, but the price is starting to get maybe a little bit ahead of itself. Not to the point where I would consider selling, but you have to probably be careful if you're considering starting a position here. But we talked about PayPal, and it's growing 25% and 20%.
Yep.
MasterCard is benefiting from those same kind of tailwinds. So huge growth in that business. So
yeah,
they're clicking on all cylinders.
If it's not one that you're rushing out to buy today, is it certainly one that if we had a market pullback or whatever you want to call it, and the market drops 10% over the next couple months, is this one that you'd be putting more money into?
Absolutely. This is a really high quality business. I think this is one that investors should keep an eye on.
All right. Well, you are winning the stock draft right now, but this isn't a 2-month competition. This is an annual thing. We're going to look in 5 years out, and I think I'll have the crown then, but we'll see.
We'll see.
Well, thanks for being here, Billy. We appreciate it.
Been a pleasure.
Thanks for watching. Thanks for listening. If you're on iTunes, we are now on iTunes and Stitcher in a podcast form. You can also tweet at us. We are at TMF Financials. You can tweet your questions, comments, and we'll address them right here on the show. Thanks for watching. Thanks for listening.